By my reckoning, no less than 17 FTSE 100 firms are due to release results or host their annual general meeting for shareholders in the coming week, so it's going to be busy. Potentially notable statements include those scheduled to come from Minor Anglo-American and the London Stock Exchange Group on Tuesday the 24th, British American Tobacco, GlaxoSmithKline, Persimmon and Whitbread on the 25th, Barclays, Just Eat, Shell and Taylor Wimpey on the 26th, and Royal Bank of Scotland on Friday the 27th. But even after that lengthy and august list, I suspect another bank is the name most likely to cause the biggest fuss in the week ahead, and that is Lloyds, which is set to release first quarter numbers on Wednesday the 25th of April. The government finally sold down its stake to zero in 2017 to return the bank to private ownership 9 years after the bailout of 2008. And it's possible that that has caused a bit of indigestion as the shares have largely gone nowhere fast over the past year. And that's despite another increase in the dividend and even the announcement of a £1 billion share buyback alongside the full year results. Now, other factors may be work when it comes to this flaccid share price performance, including Brexit and whether it will be good, bad or neutral for Britain's economy, the UK housing market and whether it's overheating or already starting to cool, and Lloyd's own strategy update back in February. Chief Executive Antonio Horta-Osorio announced a £3 billion investment in new initiatives, including greater digitisation and improved online services. That did change the investment case a bit, which had previously been really about cost-cutting and how earnings had the potential to improve when, or if, costs related to conduct litigation, restructuring and bad loans finally began to fall. Lloyd's first quarter results on the 25th will therefore be a good test, and all initial attention will focus on the headline operating profit number. A year ago, this came to £2.08 billion, so that's your benchmark for the first quarter by way of comparison. Note, however, that a year ago net profit reached just £890 million, and as we can see here, the gap between quarterly operating profit and net profit has been very big on several occasions, going back up to Q1 2013. This is because Lloyd's profit and loss account has been burdened with those hefty loan loss and impairment charges, restructuring costs, and also litigation and conduct provisions relating to things like protection payment insurance, or PPI. This next chart shows how all those three have added up on a quarterly basis, also back to the first quarter of 2013. If, and I stress, if, these three numbers start to diminish and net profit comes in a lot closer to operating profit, allowing for tax, then Lloyds could start to look like a very profitable and cash-generative bank indeed. And that is still really the bull case for the stock, although the new investment plan does muddy the waters a little bit, as mentioned before. In fact, Lloyds was not the only bank to talk about greater investment. HSBC did so too, and this may be one reason why the bank sector's lost a little bit of momentum of late. We can see that trend right here, with the FTSE All-Share rebased to the bank sector index. Banks have outperformed the broader benchmark over 12 months, but after the recent loss of momentum, the bank's index is down by some 7% in 2018. That means it's only the 27th best performer among the 39 industrial groupings which comprise the FTSE All-Share. When it comes to Lloyd's numbers, analysts will also be looking at growth in loans, deposits and risk-weighted assets. This chart shows the recent trends here, and I guess Lloyds, which has also just made an acquisition in credit cards, may be looking to return to growth as a result of its digital investments and that particular deal. Skeptics may also point out how Lloyds is still shrinking itself back to health. As we can see, loan growth and deposit growth have been nothing to shout about for some time, while risk-weighted assets on the balance sheet are still shrinking too. Personally, I find it hard to see why Lloyds is going to suddenly start growing rapidly again, given that the UK is a very competitive, mature and tightly regulated banking market. The national savings rate is already low and debt is already high, unless, of course, Lloyds really pushes the boat out on credit card and mortgage lending and perhaps starts to take a lot more risk again. Now, I'm not sure that's necessarily what all shareholders are looking for. Most of them, I suspect, will be looking for less risk and more dividends. But let's see what the first quarter figures bring. Thank you for watching, and I look forward to seeing you next time.